Alrighty, welcome everyone to our Food for Thought speaker series. We're honored to have you all join us for this session with our Professor Richard Koss. And if you have any questions, please keep them to the end of the session. As always, the session is recorded. And if you have questions, during the session and you want a clarification, you put your questions in the chat. We're honored to have you all with us, and we have sessions every week. So our session today is going to be on the new housing policy, and I'll hand it off to Bill to do our quick intro. Thank you everyone for joining.
Thank you, Jeremy, and thank you to you and Valerie for keeping the series going. Now we're well into our second year, and we've had many distinguished speakers and covered the kind of topics that SEPA covers in more depth. And here's an opportunity for our community and those outside our community to learn more about some of the most important challenges of the day and how we can make progress on them. And we're very honored to have Professor Koss with us today. He knows as much or more about affordable housing as anybody in the country and maybe anybody in the world. He has a long career in housing, a big chunk of it at Fannie Mae, which is a market maker and mortgage holder for affordable housing, and has been for many years in the United States, a quasi-governmental organization, which maybe at some point he can explain to us a little bit about that. He's currently working at cutting edge for a fintech company, working on big data with mortgages here in New York called Recursion. He's also teaches here at Columbia, affordable housing and housing in general. He's been a visiting scholar with the IMF. He served not only at Fannie Mae, but worked as an advisor to a number of private organizations, including General Motors. He was a senior vice president at a Wall Street firm, Brown Brothers Harriman, and he's taught at Johns Hopkins as well. So he has a distinguished career. He's an expert PhD in economics from UPenn, and actually an undergraduate degree from Case Western in statistics. So he's very experienced in the real world. He's academically at the highest level. He's done a tremendous amount of research, and he has an excellent paper which is on the site for you to refer to after the talk today, or maybe you've already looked at it. But Richard, thank you so much for joining us today. We really appreciate it, and I'll turn the session over to you.
Well, thank you very much, Bill, for that very kind introduction. It is a pleasure and an honor to be associated with SEPA, and it's always exciting to be involved with the activities here. And I also want to thank Jeremy and Valerie as well for all of their support in putting this together. So, as Bill mentioned, I spent some time at Fannie Mae. So Fannie Mae and Freddie Mac are the two so-called government-sponsored enterprises, and they set standards for mortgages, they insure mortgages, and they securitize mortgages. They are a crucial part of the infrastructure in the mortgage part. I went there in 2009, right after they collapsed financially, and they were taken over by the government and put into conservatorship. So they are nominally private companies, but their shares are owned by the government at present. They were losing a vast amount of money then. Within 4 or 5 years, they started making money again. I left in 2015. I joined the IMF, and partly because I wanted to write up what I saw at the IMF. And I wrote a IMF working paper called Stabilizing the US Housing Market. It's longer and denser than the paper that's on the website now. Following that, I met my partner Lee Chang at Recursion and had the opportunity to come to to SEPA. So I relocated back to New York, and I've been here since 2018. And this is now my 4th year starting at SEPA. So very exciting in that regard. The paper that's on there is then sort of my thoughts since the first paper, since about 2017 when that was posted. A lot has gone on. And it's called The New Housing Policy. So housing policy has evolved a lot in the last few years, and that's what I kind of want to get at. I have a few slides I'm going to share. I'm going to run over them relatively quickly. And hopefully everybody can see this okay. I can start from here. And I just thought I'd talk a little bit about the history of housing policy. And I would start about 20 years ago and move quickly to the present. Housing policy before the global financial crisis, before about 2005, 2006, is very easy to talk about because there really wasn't very much of it. Policy was very much focused on fiscal and monetary policy. Housing was very secondary as it fed into the two of those. Over time, there had been criticisms of that approach, but the best paper from that regard was written by Ed Leamer at UCLA, who wrote a great paper called Housing is the Business Cycle. He published it in 2007. It was prescient. The housing market collapsed, and through the mortgage markets, through the securitization process, it brought the global economy to its knees. I would add that we often call this period the global financial crisis. So it would be remiss for me at SEPA to not point out the G in the global financial crisis. It's not just that the US experience resonated overseas, it's that other markets experience housing bubbles as well, notably in peripheral Europe. So it really was a big global experience in that part. It was during this period that the Fannie Mae and Freddie Mac were put into conservatorship. And that's when I joined Fannie Mae in 2019. Now, the policy response here was quite significant. The first thing was that the Federal Reserve set interest rates to zero practically immediately. And they started a program where they started buying mortgage-backed securities themselves. This was designed to put downward pressure on mortgage rates to allow the mortgage market, the housing market to recover. Housing was clearly suffering, so the program was implemented directly to there. The fiscal response was a decent size, but it was maybe only a third to a half of the gap, between potential and where the economy was. In that sense, it wasn't all that strong, okay? The other thing was that banks became very risk averse and policy changed to discourage them from lending because it was lending that blew the system up in the first place. So we had a lot of monetary policy response, moderate fiscal policy response, and actually contractionary response from the lending side. And you can see when the housing market peaked in 2007, it didn't trough out really for 5 or 6 years after. This was a very long, involved process. And it didn't really start coming back fully until several years after that. So this was actually quite the long process. Just like what happened, and I can stop sharing now. Just like what happened, with a few forward-looking people going into the global financial crisis, there were a few people, however, who noticed another effect of this combination of policy. And the market somehow became more stable, but it also became more unequal. And this was something that just started to gain attention in a serious way in policy circles. I need to share my screen again. At the end of this period. Okay, there we go. So I have a couple of charts on this page. So the credit score, often known as the FICO score, is a measure of the quality of the borrower in terms of their ability to pay their bills. It's a number that runs arbitrarily between 350 and 380. Going into the financial crisis, it was in the low 720s. Afterwards, it went up a great deal. That's a severe tightening. Only the very best borrowers were allowed to get mortgages. It drifted down a little in subsequent years, but still well above where we were in that 2007 period. And who is it that gets hit by this? And this is a graph of the gap between white and black households in terms of their home ownership rate. So this credit tightness fell disproportionately on lower income and minority borrowers. And there were a few articles written about that. I referred to them in my paper. Okay. And at this point, I mean, this was in about 2018, 2019. And at this point, it was starting to pick up, but we ran right into the COVID crisis then starting in early 2020. And the remarkable thing about COVID was that it took these inequalities that I think we were becoming aware of, that the policy establishment was becoming aware of, and it blasted it open for the whole country and the whole world to see. The cost of the COVID shock fell very heavily on low income service sector workers, as people weren't going to restaurants and shops and movie theaters and this sort of thing. And so it fell very heavily on this cohort. So in addition to the tragic situation with the with the social unrest around that occurred last summer, this became a key issue. And immediately following this, we got something of a more strenuous policy response than we got earlier. So if I share my screen once more, here we are. So what happened in this case? Well, the Fed, once again, they're an independent agency. They can operate very quickly. So they did what they did before, and they actually did a lot more. They set rates at zero. They started buying up all kinds of mortgages that help get interest rates down. They also started lending programs to small businesses. So they were a bit more aware on this side. On the fiscal side, the CARES Act, which was implemented in 2020, was a much more powerful stimulus than we got after the global financial crisis. 2 or 3 times as big in relative terms. Unemployment benefits, stimulus checks for broad households, really trying to get things going. That was much bigger. And then we had kind of a longer discussion about what do we do about credit availability, right? And so that has come more recently. First we were working to stabilize the economy, and now we're working on some of these fairness issues. A key thing about the initial response, though, so this chart, the mortgage rates on the right? So once again, the Fed was at it. They were buying mortgages left and right, and mortgage rates got very low. The orange bars relative to the right scale, reached all-time record lows. And that, plus the combination of a massive stimulus for individuals who could to flee densely populated areas for more open spaces in the suburbs and in rural areas even, generated a huge impulse for buying. So if you look at the blue line, that's the year-over-year change in house prices, right? It went from 5% below the crisis to about 20% now. That is a remarkable impulse. Look at the same blue line back in the crisis, much less. So we got a powerful boost to housing stock and to household wealth, to home owning households. That's what's really key here. So we had the effect of stimulating the economy, but the inequality, wealth gap between homeowners and renters widened considerably. In 2019, before the crisis, there was Fed data that said the average wealth of a homeowning family was $255,000. For a renter family, $5,900, 35 to 1. Right now, that's got to be a lot wider, right, with the surge in house prices that we've seen. So this sets up a situation, where the inequality element of this becomes much more important. How am I doing for time? Okay, not doing too bad. So what happened is we are just at the stages where the still relatively new Biden administration and other independent agencies, including some of the housing regulators and notably the Federal Reserve, have been thinking about ways to address these situations, okay? And so what we're seeing now is the beginning stages of what is called, which I've kind of named here, the new housing policy. The old housing policy, they were, trying to keep, families going on a path to home ownership, but it was either equal to or balanced with the idea of financial stability, right? And after the financial crisis, even though house prices were very low and it wasn't risky to buy a house at all in terms of valuation, it was very hard to get a mortgage, right? Now house prices are high and we're facing a similar situation, but there's still a great awareness that getting people, households, on a path to home ownership is an important underlying factor about economic justice that we're seeing in the world. So I go back. And here are what I think are the three major thrusts of the new housing policy. First, fiscal policy is not just spending money to stimulate the economy. Housing is being thought of as infrastructure, right? I mean, we have this infrastructure bill coming down the pike. Housing is a very significant part of that. We think of infrastructure as trains and roads and bridges and this sort of thing, but we're seeing things like education is being, infrastructure, and housing is certainly there now. The other thing, which kind of goes along at it then, is that housing is key to economic development, right? Housing in this sense is a strategic sector. It is very big. There is an enormous need for new housing, especially new affordable housing that's out there. And so applying stimulus to the housing sector is not just seen as something that's beneficial to the families who are going to be able to find better housing, but also as an overall scenario of economic development. This is not unique to the US. Some countries, particularly emerging markets, have been using this for a while. India in particular, where I've done some work, they have been treating housing as economic development for some years with a considerable degree of success. Unlike other emerging markets where, you devalue your currency, you develop manufacturing and sell this stuff, this is a more domestic-based development, and I would argue it is more sustainable in this sense. So this is something that is exceedingly important. When kind of looking at the specifics here, we're looking at so we're talking in the infrastructure bill about 2 to 3 million more units that they're going to try to push out over some period of time. As we know, that bill is still in production. There's a lot of debate on all these things. You never know how it's going to turn out. They recently came out with a program to develop 100,000 new houses independently of that over the next 3 years, right? Housing takes a little while before it rolls out as a separate initiative just to get the ball rolling as far as this goes. The second prong to the new housing policy is access to housing and credit, okay? And of course, issues like redlining, they've been around a long time. The Fannie and Freddie regulator is FHFA, Federal Housing Finance Agency. Their new director is Sandra Thompson, who is a longtime employee there working on affordable housing. And when she took the job, she noted that the Black-white homeownership gap is actually wider now than it was in the 1960s when the Fair Housing Act was built, when it was still legal to discriminate, right? That there are institutional factors to the markets that have allowed this discrimination to not just not get better, but to actually worsen in terms of the result, right? It's illegal to discriminate against any factor besides your credit quality, right? Your FICO score, your income, all these sorts of things you're allowed to factor in, but not race or age or characteristics that don't have anything to do with that, right? And nonetheless, the result has been quite negative in this regard. And so we're starting to see sort of administrative developments go on the side. And among these are innovations in underwriting. The FICO score mostly tracks how well you pay your other debt, credit cards, student loans, auto loans, this sort of thing. But a lot of the money that young people make goes to things like paying rent and phone bills and this sort of thing. And so sort of interestingly, just a couple of weeks ago, Fannie Mae announced that they are going to be including rent in these calculations. That's difficult because if you don't pay your credit card, a report goes to a credit bureau. Most landlords don't report, so they're having to look at the bank accounts of the borrowers themselves. But this is a significant innovation, I think, and could be an important step along the way to reducing some of these barriers. The other thing that FHFA did was that they have required Fannie Mae and Freddie Mac to identify the barriers to home ownership for low income and minority families and to write a report on what they can do about it and have that report due at the end of the year. They need to come up with 3-year plans to apply this. They're also requiring Fannie and Freddie to devote a greater share of their resources to serving low and moderate income people. So we're seeing a big wave in terms of specific housing policy to address this. The final one I want to talk at a little bit is bank regulation. So bank regulation takes place across the banking regulators. The one that's most famous is the Federal Reserve, of course, but there are 2 others, the FDIC, who insures your bank deposits, and the Office of the Comptroller of the Currency. So we have 3 different agencies. They have something called the CRA, the Community Reinvestment Act, where banks are required to demonstrate that they provide services to low-income people in the markets that they serve. The Fed has announced a new regulation is going to be written, and I expect it to contain a lot more specific points about financial inclusion and credit disparities between groups. I think it's going to be much tougher and much harder. Lael Brainerd, who's spearheading this effort at the Federal Reserve, has a long history of this, and it should be very interesting. So I'm going to conclude with, still doing okay, what I view as the challenges to these programs and what's the policy suggestions that I have in dealing with them. The first challenge they have is coordination. I've already mentioned in this talk a substantial number of organizations, there's HUD, there's the housing agency, there's the CFPB, the Consumer Protection Agency, there's the GSEs themselves, there's FHFA, I mean the Fed and the bankers, and many, many more in this regard. And a key issue with this is coordination, right? Some of these are federal agencies, but many are not. Now, we're fortunate in that certainly the Fed is very independent, right? You can have somebody there who has a very different view from the administration on these issues. I don't think that's the case now. That's there as well as these others. Now, fortunately, the CFPB and the Consumer Agency and the Housing Agency, they just got Supreme Court rulings that said that the president can replace these people, which is what happened this year. But coordination is a substantial issue. One way that it comes out is besides Fannie and Freddie, we have government programs. Federal Housing Administration and VA in particular, Veterans Administration. And they are not part of the GSEs, Fannie Mae and Freddie Mac. FHA in particular historically serves first-time home buyers and low-income buyers. As the GSEs step up their efforts in addressing issues from their side, you have to deal with the question of how many new people are being brought into home ownership and how many are just being shuffled from one government program to a semi-government program. And that's one thing that needs to be looked at, and I haven't seen much going on with that. The other thing is that more than half the mortgages these days are not made by banks. They are made by non-banks. Quicken Loans, Rocket Mortgage is the most famous of these. They are not banks. They don't take deposits. They're not subject to bank regulation, but they are a great big part of this market. And significantly, their main regulators are not the federal regulators that I've talked about, but state banking regulators. And you were thinking about coordination among the federal regulators. Well, you've got 50 state regulators, many of whom are appointed by people very offline with whatever's going on at the federal level. And without the efforts of the non-banks, that begins to be a bit of a trouble. Now, I understand they're looking at that at the Fed, so we're going to have to see what comes up with that. A second element that I bring up that doesn't get talked about that much, but I run into it a fair amount, is data availability. The agencies, Fannie Mae, Freddie Mac, Ginnie Mae, release loan level data pretty much every month on what they're seeing. These are massive data sets, billions of rows of data. The HMDA data, HMDA, home mortgage data, every year the banks release data to the consumer agency that shows characteristics of the loans they do in that year. That's also a large data set, but there's a lot of data that is not available publicly. In particular, there's a lot of data that the banks have that can be very helpful to analysts and policymakers on this regard that are not there. There is also not good central access to pricing data. In order to look for discrimination, we need to get very accurate data on what the charges and fees are that people are paying. This data is owned by the banks. It's given out to other private distributors who are thinking more about making a profit than making it available. So there are things you can do, perhaps some sort of government data registry that makes this more available to local governments and researchers that would help design these policies. The last point is NIMBY, not in my backyard. A lot of the programs that we're talking about here are demand side programs, making credit more available. But a lot of the problem is also that there is not enough supply of housing. If we just make more credit available and don't increase the number of houses, it's just going to put more upward pressure on house prices. So what's going on, and this is part of the infrastructure bill and also part of some new HUD programs on the rental side, is that money is distributed to local local municipalities based on their trying to lessen the impact of local zoning regulations that are designed to prevent low-income housing from going into particular areas. This is absolutely key. We've seen a couple of states, California and New Jersey, trying to migrate these zoning decisions up to the state level so that they have a much broader view in this regard, but there's a lot more that needs to be done in this respect. So this is an ever interesting topic. I will just conclude with that, and I would be very happy to have discussions or take questions. Thank you. Thank you.
Professor.
That was great, Richard. I'll start us off. So the zoning issue, I think, is, from my perspective, perhaps the greatest opportunity to create more, a higher availability of affordable housing.
Yes.
It always has been, but as you point out, only recently, I think, has there been a recognition by policymakers at the federal level that if they don't do something to deal with that issue, you're almost caught, right, one way or the other.
That's right.
How realistic do you think that is?
That's the great question, and it's my biggest worry. I mean, you know, the resistance to this sort of thing is massive, right? You know, and I mean, you know, even in New York, right? I mean, we have very progressive people, you know, and who will vote progressively all the time. But if it comes to there's going to be affordable housing somewhere near them, you know, immediately issues about crime and congestion and all this sort of thing come up. And, you know, it's just, you know, concerns about property values, you know, are absolutely overwhelming in a lot of this regard. So I think it can happen in some places where you have state and city governments that are aligned on these issues to try to overrule this sort of thing and to create financial incentives. But in much of the country, there's not going to be that constraint, although I guess a lot of the congestion is in probably the more is in areas that's more inclined to deal with that. But it's going to take a while, and it's going to have to be fought hard to make the kind of progress that we need. I'm not, you know, I'm not trying to play down the risk, but I think you're right. This is the top issue they've got to get on top of.
I don't want to dominate this at all. I just quickly make one point. Everything you say is true, you know, but on the other hand, I was born in New York, I've spent most of my life here. You can see examples of where the concerns that people have are really not founded in reality. Just two quick for instances, right? Historically, one of the richest areas of New York has been the Upper East Side of Manhattan. And in the Upper East Side of Manhattan, you have luxury housing right next to public housing. Yep. Like literally right next door. The lowest category of housing in terms of finance and the highest living on the same block, right next door, no problem. Yeah. The other example is on the west side of Manhattan, which used to be where West Side Story was set, which used to be a ghetto, which is now Lincoln Center, and assorted high rent housing and high ownership housing right across. And on the other side of Lincoln Center, on the back side of it, is all public housing.
Yep.
So clearly it can work.
Yep.
Clearly it does work. So I'll get this to a question, and it's really my last one. Since local governments control this, couldn't mayors actually say for new development, if you want more height, if you want more units, mix income. And if you do it, we'll give you more value, we'll give you more density, and we'll give you more height. And if you don't do it, we won't let you do anything.
that's completely fair. And I'm with you, right? I mean, we have the Frederick Douglass homes right by campus, right? I mean, it's
Yep.
not far at all, and I'm very comfortable, being around there. So yes, that's right. And education is a big part of it. But it's going to take a huge effort. But having the financial incentives right and aligned and significant is going to be key to this.
Yeah, I think so too. I mean, incentives tend to work.
Yes, when they're enough. Yes,
Thank you.
of course. Anybody else?
Thank you for the presentation. I think one main thing that has shifted in the housing market since the global financial crisis is the rise of and increased size of single family rental REITs and other home ownership groups. Do you believe that there should be some level of regulation of those entities as well? Because I mean, in effect, they've been reducing the ownable housing stock. I think they account for close to 20% of all housing stock at this point, while about 5% of new construction or construction starts recently have been those owners adding to the housing stock.
That is a great question and a great comment. So the biggest policy mistake, the biggest missed opportunity was after the global financial crisis, and there were all of these houses going into foreclosure. They were dirt cheap, right? By any sense. And we had created this giant fund. Remember that? Some hundreds of billions of dollars. Some of that money was used to bail out banks, right? On this regard. And instead, what happened was that private investors who saw an opportunity and had capital, right? Even if they don't borrow, they have investors who saw an opportunity that way, and they scooped up a sizable portion of these properties. There's all these stories about going to auctions on courthouse steps with guys with bags of $100 bills, just buying houses for a tiny fraction of what any sense of their long-term worth would be, right at that time, right? That they were sent out that way, and and they made a lot of money, and it would have been much better if we could have centralized that and directed it to the households that needed it, but so it goes. Now, this time, of course, the problem is housing is not historically cheap. I mean, housing prices soared, right? So we're not seeing the same activity in terms of buying houses, because by this metric, they're not cheap, but the build side is real, right? I mean, building is picking up, and there's a share of this on that side. So how do you correct that, right? Do you expropriate these houses from the private firms? I mean, you start getting into some stuff that's pretty out there. So it's easier to identify what went wrong than it is to say what you can do about it now. And that's the thing. But it's an important topic, I think.
Thanks.
Richard, I'm sorry, go ahead. I'm sorry.
I was just going to say, kind of as a follow-up comment, so I think relative to household incomes, housing prices obviously have increased dramatically, but I come from the real estate investment sector previous to being at SEPA, and I think with how hard it is to find yield in more traditional real estate sectors, I think investors continue to see the price of single-family homes as attractive, just from a return perspective. So I think that it seems like they're in, like you said, you don't want to get into the dangerous, or the messy, business of expropriating housing stock from private corporations, that kind of thing. But do you think there's something that we could do going forward to deter that in some capacity?
So that's really interesting. So a fair number of these investments have been made by individuals, not just companies, right? I mean, a lot of people as well as these companies. It's easy to pick on them. We're also behind this. If you had money in savings, it was a great opportunity, and there were certainly people who were there. And you can get financing for that. So under the current rules of Fannie and Freddie, and in a single individual investor can get a mortgage for up to 10 investment properties, right? And times the number of investors, that's a fair amount. Not long ago, FHFA, the regulator, put a cap on the number of investor loans that the GSEs were allowed to make. What's kind of interesting, in the new administration, they have temporarily removed the cap, okay? And so it's going to be interesting to see what happens to that. Part of the reason is because we're pushing them so much to do housing for lower income folks that, you know, there's some concern about the financial impact of that. So they're letting them, you know, provide some mortgages to individual investors who have the funds to do it. I don't, you know, I think this is something as a broad picture that they're still working on. But yeah, it's very interesting. You know, I think land is a big part of it as well. There's the notion of land banks and others around, where having land set aside for and often public land for development and being able to control what goes on it is a part of the solution as well.
Adela has her hand up.
Yes, I have a question for you as well. And it is this, a minor technical question. Was the money that was given by the federal government to cover, you know, like rent, was that only for landlords or also for mortgage holders like banks, you know, during the pandemic and going forward and so on, the extension of that sort of exemption from paying? And the other thing is, just jumping to a related policy field rather than just looking at housing, what is the impact of that on national debt? I mean, in the sense that the United States now is way, way past the IMF recommended amount if you're going to have any national debt. It's way over 100% of that, along with Venezuela, Greece, North Korea, and Italy, like what are called failed economies. And so how much can we do of that type of thing, you know, reimbursing landlords and so on, without creating a burden on future generations, which we care about so much in sustainability studies? And already they are shouldered, you know, they have on their shoulders education debt, credit card debt. I've read that this generation has more debt, 3 kinds: national debt, education debt, and credit card debt on their shoulders than any other generation in American history. So how do those policy areas link? Is there an impact, or do you just see that it's okay, it's going to just dissolve?
Well, so great questions, Paul, and far more than I could possibly get into with the justice it deserves here. But just a couple of points. One is that right now, you know, the cost of forbearance is basically shared between the banks and the government agencies. But if you look, I mean, Fannie and Freddie are semi-public. FHA, which is the government agency that deals with lower income borrowers, their financial status is wonderful. And the reason is because the market is doing so well. There is so much activity that the benefit of the housing market being so strong is greater than the cost of bearing the cost of these programs. So it actually hasn't popped up yet as an issue on this side. And then that deals then naturally with this issue of debt on this side is that right now it really isn't contributing to the national debt. That can obviously change. It was much, much worse during the financial crisis when house prices fell 35%. That was trillions of dollars of losses, generated a giant thing, right? It's just not like that. And partly it's because the policy side, like, I mean, this is a debate, right? But we didn't use fiscal policy that much in the global financial crisis, partly because of a concern of the debt. But what happened is the private sector caved, right? It just collapsed. So their debt got much worse, right? And in this case, the CARES Act, which was done in the last administration, right? It came in with much, much bigger. And the result is that of course it's added to the debt, but I think the doom and gloom scenarios are not there. In terms of the broader issues of debt, it's a great long-standing debate. I would just point out that with interest rates so low, while debt is high, debt service is not so much. And so as long as rates remain low, it's not much of a problem. There's no guarantee that will stay that way forever, but that's the kind of trade-off you have to think about when you're making policy.
Thank you.
Mhm.
Hey, Richard, what about taking advantage of all the vacancies in commercial real estate and converting that to housing?
Well, there we go, right? I mean, that is a very great point. Something like 25% of Manhattan office space is unoccupied, right? I hear numbers like that. And it's retail as well, right? It's also big. I mean, some of those are being converted to offices as a first stage. So I think that's there. What somebody pointed out was, and the comparison is bad in some respects, but right in the other, which is what happened to Lower Manhattan in the wake of 9/11. What happened was many of the big employers who were down there up and moved, right? Their employees went through this horribly traumatic experience, and so they moved to Midtown and away from Wall Street. And now, 20 years later, Lower Manhattan is a much more mixed. It's a residential area. It's become more livable than it was when it was much busier before, right? The thing is, there are a lot of impediments from doing that quickly, right? You've got long-term leases. You've got commercial securities backed by these loans that are long-term. It's just going to be an eventual amount, but I think that will happen. I think that you are going to get this, but it's going to be part of the scenario in 2030 rather than 2024, I would guess.
Thank you. We've got time for one or two more.
Yeah, I had one question. I just want to thank you. This has been a really, really great conversation. I'm just curious. I know you touched a little bit on this about local regulations, but I want to go back to ask, like, what kind of tools are there to put pressure on, like, the high income, high opportunity communities to loosen local zoning regulations when they really are some of the communities that have the least need for the federal funding?
That is a wonderful, wonderful question. And one that, we're trying to get our arms around, right? Just before the crisis, New York City and to some degree the state shocked the powers that be, in the development area by imposing all kinds of restrictions on evictions and on converting affordable housing to market rates and imposing taxes on high level workers in this regard. And a lot of the impediment has been with this, that these guys famously bankroll candidates, right? In this regard. And it seemed like the public sentiment about this just became so great that they didn't much worry about that, right? We had, and you get these threats. Well, we're going to move to Florida. Well, yeah. How does that look right now, right? I mean, we just, the condos are collapsing, and climate change is going to bury the place in water. But, but yeah, I mean, it's again going to be a long slog. Can you regulate developers and owners? That's an interesting question. I mean, there's no previous basis for that, but something you could think about, I guess.
Last comment,
Anybody
last
else?
question?
Comment?
I actually have one.
Sure.
I think it's related to TJ's point from earlier. I think we've seen a lot of articles about BlackRock buying up the single family homes. And I think we covered a little bit of that, but my question is more related to, is there a precedent for this? Is it really that big of a deal? And how does that impact the new infrastructure bill if there's any regulation to prevent that?
Right.
Because it seems like the trend is,
Yeah.
it seems like the trend is moving towards more renters rather than homeowners. If that's the case, they're just buying up all the housing stock.
So that's a great question, and it's something I'm going to grapple with. I would just one small correction: it's Blackstone, not BlackRock. That was doing this. They also sold their major interest in this, their Invitation Homes subsidiary, a few years ago. I think it was becoming difficult for them to carry this because of this kind of criticism. I've heard lately they may be coming back a little bit. I'm not sure in this regard. So they're an interesting question, but they were the ones who started this model, right? And came up on this side. And so it'll be interesting to see where they go with that. In terms of the number, what people who justify it say as a share of the housing stock, it's not that big. And that's true. It's not, right? A third of houses in the US are owned. They have no mortgages, right? I mean, it's just, and it's pretty concentrated. In the New York area, you don't see many houses like this, right? I mean, not that many, even with house price drops that went into foreclosure. And what you need is scale, because for this model to work, you need to have an infrastructure of people who can maintain lawns, be the plumbers, all of this kind of thing that you have. And so it's kind of like a giant condo, if you will, but it's spread out. If it's just 5 here, 10 there, and some miles away, the model doesn't work. And so it's pretty focused in parts of the country, down south, parts of the Midwest, and this sort of thing, right? Obviously the onesies and twosies from small landlords can pop up, but I don't know if there's anything you can do about that. So I would have these arguments with these people there. I would say the stock is low, but the margin is high, the flow, right? I mean, they were a relatively large part of what got bought in the aftermath of the crisis, but the numbers are still not that big. I don't have them in the top of my head, but I think it's single percentages of the market. It just on that side doesn't look that big. But yeah, it's a discussion that's well worth having.
Oh, I think we're just about out of time. Richard, that was really a fantastic discussion, presentation, set of issues on something that's near and dear to my heart. And I think sometimes when we talk about all the great needs in society, like climate change, like healthcare, like education, housing doesn't get mentioned a lot of times. And yet, as someone who grew up very poor, my family on both sides was transformed by the first set of people who actually ended up buying their own house. And that changed everything.
My grandfather was an immigrant from East Europe 100 years ago. And, he worked in a factory and he had a government sponsored loan, and that's what brought him in my family. Yeah. So
same thing in my family. My father worked in a factory. So
yeah.
I think more and more, I hope at SEPA, with your course and others, we can get people thinking more about, as we try to come up with a multi-pronged strategy to bring more equality and opportunity to everyone in our society, that home ownership becomes part of that discussion, because I think it can make a huge difference.
Absolutely.
Jeremy, I'll flip it to you.
Alrighty, well, thank you everyone for joining us for our Food for Thought. I want to thank Professor Koss once again for his fantastic session. And you can find our sessions on the Food for Thought website, which I put in the chat. And you can find past sessions, the recording for past sessions, and the registration links for the future sessions. So Professor Koss, thanks again for joining us. And we'll see all of you again soon.
My pleasure. Thank you, everybody.